So students, in the last session we had a discussion about this adjusting entries. So now we need to solve problems on independent branch. In case of independent branch, the branch will maintain its own books of accounts, but the head office may have to incorporate those entries in its book. Come for 2005 question paper. The following position is shown by the books of Bombay Business and its two branches as on 2004. Students, in this particular problem, there is no journal entry, there is no trading and PL account as such. At the end of the question, they have asked you to prepare balance sheet. So you need to prepare a consolidated balance sheet. That is balance sheet of head office plus balance sheet of two branches. So all the three branches, all the three balance sheet you need to merge together. So we have capital 25,000 will come, creditors 3,000 will come in the consolidated balance sheet. A branch current account ignore, PL account, then plant and machinery, stock, debtor, all the three will come in consolidated balance sheet. B branch current account ignore because it is a transaction between head office and the branch. It will not come in the balance sheet. Cash will come in the consolidated balance sheet. So what we consider: capital, creditor, plant and machine, stock, debtor and cash. So we take only assets and liabilities. Remaining inter-branch assets and liabilities we are not taking into consideration. Yes, we have the balance sheet of A branch. So creditor we should take in consolidated balance sheet. Head office current account ignore because it will get offset in the consolidated balance sheet. Stock, debtor, cash, all the three should be taken. Next we have balance sheet of B branch. Creditor, yes, you should take in consolidated balance sheet. Head office current account ignore. Then you should take assets of stock, debtor and cash in the consolidated balance sheet. Upon investigation, it was found that the following transaction had taken place on 31/12/2004. Bombay office forwarded goods to the value of 500 to branch A and 600 to branch B, which were not received by them until 3rd January 2005. That means it's called goods in transit. The goods are sent, but it is not delivered before 31st of December. It is delivered after 31st of December. It is delivered after closing the books of accounts. So it is delivered on 3rd January. So 500 and 600 is called goods in transit. Will come in consolidated balance sheet asset side. Branch A remitted 400 cash to Bombay office, which was received by it on 2nd January. This is called cash in transit. That means cash is sent, but it is not delivered to head office. So it's called cash in transit. It is not delivered before December. It is delivered in January 2nd. So it's an asset balance sheet. Branch B returned goods worth rupees 200 to Bombay office, which is received by it on 3rd January. This is also called goods in transit. So there are two goods in transit. In point number A, 500, 600. Point number C, 200. So we have three goods in transit and one cash in transit. You are required to pass journal entries in the books of head office and prepare a consolidated balance sheet of the whole business thereafter. So this is a consolidated balance sheet, students. Capital 25,000. Creditors of head office, creditors of branch A plus creditors of branch B. Then PL account as appears in the balance sheet of head office. Plant and machinery only appears in head office. No plant and machinery in branch A and B. Then we have stock, head office stock plus two branch stock. Debtor, head office debtor plus A branch debtor, B branch debtor. Cash, head office cash plus A branch cash plus B branch cash. Then goods in transit, there are three goods in transit, 1,300. Then cash in transit given in adjustment 400. So total we get 42,900.